Hi everyone, welcome to the Timing Research Show for June 6, 2016. Today we will be talking about the 141st report from Timing Research. So if you haven't had a chance to take a look at this yet, just go to TimingResearch.com and you can download this or any past reports there. My name is David Kosmeter. I'm the creator of Timing Research, and I have Rob Hanna here to moderate for today. So I'm going to go ahead and turn it over to him.
Thanks, David. Thanks for having me back again. Looking forward to another interesting conversation here. 141st report. Sure sounds like a lot. And I am here today with, we've got Lance Ippolito of AlphaShark, John Thomas of Mad Hedge Fund Trader, Dean Jenkins of Follow Me Trades, and Henry Schwartz of Trade Alert. So I guess before we get going too much in the conversation here, why don't I go through and you guys can introduce yourselves. I've talked to a couple of you before, but I don't think I've talked to everybody. Lance, you're at the top of my list on my piece of paper here, so I guess that makes you the one that gets to go first. You want to tell us a little bit about yourself and a little bit about AlphaShark before we get going?
Yeah, sure. So I'm a CTA by trade. I'm a trader and educator at AlphaShark.com, where we have, or I guess our main focus is unusual option activity. We also have futures traders. James Romelli usually trades earnings. Andrew Keene, more of an unusual option activity trader. So we have pretty much everything going on. Also volatility trader and Tara. But mostly our bread and butter is unusual option activity. Trying to find unusual options in names throughout the trading day. I'm located in Tampa, Florida, which actually would have a tropical storm hitting as I'm talking. So if anything goes out, it's probably me with the power. But so AlphaShark, we do have a live trading room from 8:30 a.m. Eastern Time all the way till 4:30 p.m. Eastern Time, and we also put on webinar series to our members every day of the week, and also a free webinar usually once a week as well.
Okay, so you mentioned you look for unusual options activity. Do you then trade in the options, or do you trade in the actual stocks when you see the, or in indices when you see the options activity happening?
So let's say we see MGM will be a good example, and let's say we see a lot of the September 20 calls being bought. Let's say we see 10,000 being bought at the ask or above the ask. Volume exceeds open interest. This type of trade will be considered unusual in the for our criteria, and we would just usually trade on that same strike of that same option.
Okay.
A couple of people do variations, but usually we kind of like to piggyback on the trade on the side of the institution over the large money.
Okay, interesting. That moves us on to John Thomas. John, I don't think we've talked in the past. I could be wrong.
No, I haven't had the pleasure. I have a service called Diary of a Mad Hedge Fund Trader. It's a global long-short macro strategy. We put out a daily newsletter, weekly global strategy webinars, and we have about 25 lunches around the world. I'm also frequently on television and speaking at conferences. We have an average annualized return of 37% a year with our Trade Alert service, and we have readers in about 135 countries. Right now I'm short Japanese yen and 90% cash. I think the world is sitting on its hands waiting for Janet with either a no or a yes on interest rates, having potential cataclysmic effects on all asset classes. So just in the process of moving my base of operations to Switzerland for the summer for 2 months. That's what I'm thinking about right now.
That sounds nice.
I'm even wearing my Switzerland shirt for this panel discussion today.
All right, and I see we've got the entire panel actually wearing shirts today, so that's good too as traders.
Hurricane country.
Yeah. Well, yeah. If Lance gets knocked out, he's blaming it on the storm. But I'm just going to claim I gonged him.
Actually wearing the fishing shirt for the hurricane. So if the rain comes inside, I'm waterproof, you know.
Yeah. And your life jacket's under your desk, I bet, too.
Of course. How'd you know?
John, you mentioned you got a yen position right now. What your trade alert service you mentioned? What do you trade in that? Is that
Well, it's
currency or stocks or a whole match?
Every alert gives a range since everyone's risk tolerance and experience is different. So when we send out alert, we start with a put spread, outright short, an ETF, a 2x ETF. We give a whole range of possibilities to let people pick and choose what they're able to do, or legally what they're able to do. A lot of pension funds, for example, are not allowed to do option spread. So we give people a choice, and we give them all the reasons why the yen is going to go down, with a big research piece to follow.
Okay. All right. Interesting.
If the yen stays at this level, the Japanese islands are going to sink into the Pacific. It's that bad.
All right. Well, thank you. We'll look forward to hearing more about it a little later on too. Dean, we have talked in the past. I remember having being on a show with you in the past. So it's good to see you again.
Yeah, I think we argued last time, didn't we?
We argued last time. Yeah, I tend to argue a lot. So,
no.
So give me the follow me trades rundown again, so that all the listeners know who you are and what you do, and then we'll get to arguing a little after.
Okay. Yeah, I'm Dean Jenkins. I'm the founder of FollowMeTrades.com. Been trading about 20 years, and I've really, over the last 5 years, developed the current system that I'm using after experimenting with everything, right? But finally, you know, in the last 5 years, have a well-defined, repeatable trading system, and we got a great track record. We're averaging about 35-40% annualized on primarily stock picks, stock and ETF picks. We publish either the direct trade or an option play, so the subscribers can take it either way. I've had fun working with Alpha Shark with James Romelli. We've done some joint stuff together, and you guys are cool. I also run a live trading room. We just launched that a few months ago, so we do live trading through the open and for a couple hours. And trade futures there, you know, day trade futures, and then we have a stock picking service for longer term stuff. And I have a unapologetic bias. We only trade a very, very narrow range of instruments, and those are the ones that have a high potential to win.
Does sound like the best ones.
Yeah,
I never heard of that. I never heard of that before. Tell me more.
So, you know, I'm a technical trader. I think fundamental information matters, but it's already reflected in price action. I want to know that news is coming out, but I don't care to go read it because I'll see how the market's responding on the chart. So again, technical trader. I use a combination of Dow theory, Elliott wave theory in my trading, and you know, keep it really, really simple, real repeatable thing. Our big emphasis is on risk management, and you know, only taking trades that have a high probability, entering with a well-defined stop, controlling position size, and keeping our stats good. So we, you know, have a high win rate, and more importantly, a high payout ratio on the trades. So that's our gig.
All right, great. Henry, on to you. You're the last.
I
am. Give us a rundown on TradeAlert.com. I've heard of the service before. I haven't explored it a whole lot, so I'm interested in learning about you as well.
Sure. So we've been in the option market data business for a decade now, primarily in the institutional side. So we actually process every single trade that is taking place, which is about 1 million to 1.2 million trades a day in the options market. Every single trade in real time is augmented with side of market, so you know, basically to help people figure out if things are being bought or sold, and then kind of from that building block, we do all sorts of other really interesting things like aggregating sweeps into single trades, which is now about 40% of the flow. So it's very powerful to be able to say, okay, you know, 2,000 calls were just swept across 6 markets in 8 milliseconds from 50 to 55 cents. There's a big difference between doing that and just saying, okay, here's a 300 lot, and when the market was 55, and kind of trying to piece it together manually. So with 14 exchanges, and now it looks like there's going to be 16 options exchanges in the next few months. It was, to us at least, it was very obvious somebody needed to build a tool to help people handle that. And then more recently, we've tried to expand into the self-directed trader, the retail market, with our retail site, which is called whatstrading.com. And that's actually where we take all the analytics and data crunching that we're doing for the institutional business, same back end basically, but kind of modifying the presentation to make more sense to people that are not full-time options traders and salespeople. So and then what we've done is also pulled in technicals to kind of help people say, okay, here's a spike in call volume, which everybody, it's very popular to look for unusual option volume, and because we have kind of all the baseline levels, we can basically point out, okay, heavy volume in X, Y, Z. But to be able to say, okay, it's also the 50-day is getting close to the 200-day. That's something we haven't really seen done very well out there. So so it's exciting, and there's plenty to do.
Oh yeah, so it sounds like no shortage ideas are tested there.
No, the problem is whittling it down to the best ideas.
Yep. All right, so we got a couple of option guys, which is interesting. John does a whole lot of stuff, including currencies, and Dean focuses on a narrow window of things, a lot of stocks and ETFs. A little bit about me. I'm Rob Hanna. I have run quantifiableedges.com since 2008 is when I founded that, and then I started a little site called overnightedges.com, which merged with Master the Gap and became InvestiQuant. That was a year and a half ago or so. At InvestiQuant, what we do is we publish historical odds based on a number of setups. And one of the setups that I zero in on, in addition to the overnight, is this swing term. So I look to take advantage of 3, 4, 5 day swing trading opportunities in the markets when So that's me. I also still work with Quantifiable Edges, which is primarily a newsletter and a website that backs up a lot of the information in there, and that also is a lot of quantitative-based research. Let's move on to the questions. I'll go in the same order for this, and we'll reverse it. It looked like there was a pretty narrow split in the timing research crowd forecast this week. We had 48.5% of the people said it was going to be higher, the market would be higher over the next few days, and 51.5% said lower. But interestingly, the responses for higher were a little bit more confident than the ones that said lower. So there was more people saying lower, but they were less confident than the ones that said higher, which is quite the split. So I imagine we'll be arguing a little bit in here, hopefully. Lance, let's start with you again, and you want to give me closed to this Friday's close. Oh, I'm sorry, it's from Monday's open. So from today's open, which isn't much different than Friday's close. So from today's open to this Friday's close, do you think it's going to be up or down? And what would you say your confidence is?
If you asked me a couple hours ago, I would have said higher, just because it seems like the market just heads higher. I know Yellen is yelling at the moment, and I think again she comes back on a little bit. I'm not following her. What she's saying right now, but I saw the equity market sell off the tab. I just think this gets ignored, and we just slowly move higher. 2100 and the S&P becomes support now. Do I think we're going to move up, 20 to 30 points this week? No, but a small grind higher this week. I do not rule that out the question. So I'm basically higher to neutral, but I guess I would have to say higher, just because the market tends to gravitate up.
level. Is that right?
Pardon me?
With a higher, but with a fairly low confidence level. Is that?
Yeah, I would say that. We don't have a lot of economic news. I think we broke 2100. That was pretty big. So I think higher.
Okay. All right. John, what about you?
It's all about the Fed. Sit on your hands till June 15th. Whether the Fed raises or lowers is what it's all about. I vote for no action. I've known Janet Yellen 20 years. It's all about jobs, and until there's proof of inflation, they are not going to raise interest rates. In fact, they may not raise them this year. So that sets up a perfect false breakout. I think we may grind a couple of points higher on the news, suck in a bunch of buying, and then fail. And maybe go back down to the recent low, which was 202 in the SPYs. We've got summer trading conditions. There's just not a lot of liquidity and not enough real money coming into the market to break it out of a 2-year high. I think eventually we do break out. When we do get that breakout, it will be an explosive breakout to the upside, probably adding 10 points very quickly, because we essentially have 2 years worth of pent-up buying power that's been building up since we first hit this level a couple of years ago. I think the election is keeping people out of the market. Everyone's underweight. They're scared to death what might happen with President Trump, and they're just sitting on their hands waiting to see what happens. But when we do get the breakout, like I said, the world is underweight equities. And it's a perfect setup for a major short squeeze of the hedge funds, which are mostly playing this from the short side. And I'm sitting on my hands. I'll wait for the market to tell me, when the breakout's going to happen. I would much rather, buy the first dip after a major breakout than buy the breakout itself. Keep in mind that the high-frequency traders are fading this move like crazy. They want to suck in as many people as alongside too, so they can then slam it on the other direction. So, and the really unbelievable thing right now is how low the VIX is. To see the VIX at 13 in front of a major potentially explosive event, to me is just unbelievable. And that to me means the VIX has just been arbitrage out of any kind of relevance to current market conditions. So there you go.
All right, so it sounds like this week is kind of a sit in your hands thing. Probably not a whole lot going to happen, and then next week we'll get some real action after the.
Right, but you may want to fade the knee-jerk reaction next year. If it's up, you probably want to sell it.
Yep.
Up, down, you may want to buy it.
Okay. All right, Dean. We've got so far 2 people that aren't real excited about what's going to happen this week. Give me something.
Okay, well, I'm going to tell you what I think, and I could be wrong, but I'm not. Okay, a couple comments that John made. I think the market's terrified of President X, whoever wins. Right, the lineup is not impressive. Right, there's really no good news in any of those. It's just what set of bad decisions do we have to deal with? So in terms of whether the market's going to go up or down this week, I believe it's going down, but it's low confidence. I'd give that a 60% confidence for all the reasons already stated. We really are in a holding pattern, right? And Janet was on the mic earlier, and she's going back on again today. What would that feel like? Every time you step up to speak, that billions of dollars change hands. That's
You're very cautious in what you say. That's what it feels like.
Cautious. And I think she's not going to say a darn thing. Right?
No, nothing. Talk about the weather.
Yeah, right. So we were in the trading room this morning, right? It flatlined, and if that had been a EKG, you'd have had to get the paddles out, because everybody was waiting for her to step up to the mic, and then it got a little chaotic. And there's no news coming, and like someone else said, there's no end. But the market's twitchy too, right? Even the hint of something could cause it to move either way. So it's hard to predict. It's a tough market. It's a good time to go on vacation and come back later when a trend gets underway. But I do think, just based on technicals, yeah, I got my Hawaiian shirt on here. We had a heat wave. I'm in Olympia, Washington. We had like 97-degree weather yesterday, unheard of for early June. So anyway, yeah, better time to go boating or golfing or anything than trading until we get a trend. But I think the technicals are showing, and I'll show this when we get into the next phase here. I'll share my chart and my rationale. But we've had a pretty over the last couple weeks or last week, and we're just from a technical standpoint, a small correction is due, and that it looks like it could play out the rest of this week. So I'm staying down, but with a pretty low confidence.
Okay.
At this point.
All right. Thanks, Dean. That sounds like a guarantee to me. Henry. Do you where are you standing for this week? Higher, lower, and how confident are you in the forecast for this week?
I'm going to say higher, just because in general, I think that's kind of, that's my default. But I agree with Dean that it's very twitchy. It doesn't take much to swing this pendulum from like, the U.S. is the place to invest, given Europe's crap, to holy shit, what are we going to do here? So we're kind of up at everything is really pretty mellow right now. It's amazing how the employment number turned into be perfectly okay. I think it just shows you people are like, well, this is kind of still the best place to put your money. But I agree that it's, I think the kind of the market landscape now, with HFT and just kind of the general involvement can turn on a dime, and I don't think I'd be putting much money into the market up here. I wouldn't be moving out, but I would wait for 3, 4, 5% to the downside to kind of jump back in, because honestly, you look where we are. It's like the buying the dips, although it's kind of changed. The dips are a little bit longer in duration. It's still the strategy that's working.
And twitchy is a term that's found in all the best technical trading textbooks too.
Yeah, I got to tell you, I'm running out the number 2 on my keyboard. For 2 years, I've been putting out trade alerts that start with 2. 200, 205, 205, 210, 215, 210. I'm just so sick of being stuck in this same range for so long. Like the number 2 keeps falling off the keyboard. I got to keep putting it back on. So much.
Yeah, it is a long range. We have been locked in. So Henry, to summarize, sounds like higher for you, but kind of as a default, not a whole lot of confidence that we're going to be running way up this week.
Yeah, exactly.
Okay. All right. Well, I'm glad we got Dean here saying down. Otherwise, it'd be pretty boring. Because I'm going to say pretty much the same as Henry and Lance. I think we got a better shot at higher. I ran a little study over the weekend, and it's one I've looked at a lot in the past a number of times. But we were at a 50-day high on Thursday. The first down day from 50-day high, if that is the biggest down day of the last 10 days, then you normally get a move up over the next 3 to 5 days. And so it's a relatively big drop, right? It's not necessarily a big drop. It wasn't a big drop, but compared to the previous 9 days, it was. And you'll find yourself higher, close to 70% of the time, 4 days out from there. So that's one thing that's suggesting an upside edge to me. I also look at the InvestQuant swing data, and the 5-day odds there are pretty interesting to me. On average, under similar circumstances, and we look at seasonality, acceleration being how fast the market's moving and from where, and then kind of a persistency. So how steady, how persistent is the move? And right now it is basically no move. And where's that move coming from as well? But the 5-day numbers were pretty interesting to me in that the expectancy, you know, for being higher, you got about a 53.5% chance to be higher this Friday as opposed to versus last Friday. But on average, the losers have been a little bit larger than the winners under similar circumstances, based on all the different slices of the data that we had. So the net expectancy, if you were using it as a trading system, would be negative, right? So slightly negative, almost neutral. So decent chance that we move higher. As far as risk reward right here, we're bumping up near the upper end. There's not a whole lot of upside that we'll probably gain based on these conditions. And if we go down, there's more potential to the downside. So that's kind of what I'm seeing here. Let's go back and I'll switch up the order a little bit, and I want you to, if there's any fundamental or technical indicators that you use, could you tell me about them and let me know what it, what it is you're looking at suggesting that it's higher or lower to you. Dean, let's start with you. No, let's not start with you. Forget you. We'll put you in the middle there. John, let's start with you. You were saying, because Dean's got the, we don't want to make everybody say hi. John, you were saying sideways, and it sounds like it's just a waiting game for you. Is there anything else that you're looking at this week as far as fundamental or technical beyond kind of the waiting game for the Fed?
No, I think that the Fed basically just sucks all the air out of the room. There's no doubt that the market is going higher. Just a question of when. We could get a new high if they don't raise rates next week. But even going forward into August, September, I think the closer we get to the end of the election, the more likely people are to commit money to the market, and that eventually is what takes us up to our new high. Now, I've been saying, all year that, we hit the new highs sort of like in August and September, and then run to a much higher high by the end of the year. Until then, it's a waiting game. Too many unknowns out there, too many variables.
Yeah.
And one question I would like to ask the panel as a whole: can anyone remember a period in history where the market stayed in such a narrow trading range for so long? I mean, we've essentially been stuck in a 12% range with the S&P 500 for 2 years now. And anyone can toss in their answer when their turn comes along.
I can't think of one off the top of my head, but yeah, we have. You're right. It's been a real narrow range, and it's interesting that I looked at a study a while back. There have been other markets where we've come off of a high. So that was, when was the high? Like last April or May or something was when the S&P hit its highest high, and
Last
it has
May, yeah.
Yeah. So it hasn't had a 20% correction, and it hasn't had a new high since then. So it's been a long time where you're kind of based on, I guess, the media's definition of a bear market. They say 20% or a bear, right? Because we're not making new highs.
Well, I think
we don't have a real correction. It's just kind of a flat market for a long time, which is interesting. And like you said, when we bust out of this, we'll probably bust out of it in a fairly big way.
Yeah, I think what's happening is that U.S. equities with a 2.5% yield have become the world's high-yield asset.
Imagine that.
Nobody has anything else to buy, with negative interest rates in Japan, Asia, and the Chinese stock market falling apart. It's become the world's. They're effectively treasury bonds now, whereas the real treasury bonds are yielding close to zero.
Right. You're not getting them.
And what else do you buy? The answer is nothing. So you just keep what you have until things change. And in the meantime, the earnings multiple, now at 19 times, just keeps getting higher and higher, adding risk to the market. So, that may resolve itself in the second half of the year with an earnings recovery. It's another argument for a, second half breakout. Until then, we just have to wait.
Yep.
Also, another thing I'll throw in, institutions have not been paid for trading their positions. Essentially they've been selling every bottom and buying every top for 2 years now, getting their heads handed to them and delivering negative returns to their customers. So a lot of them have just quit trading. They'll just live with whatever happens and stay modestly underweight until then.
Yeah, that's interesting. I hadn't looked at that, but yeah, you got a lot of mutual funds that are underperforming.
Oh, huge. Hedge funds are even worse.
Yep. All right, Lance. What about you? What is it that's making you believe we're going to be grinding up this week?
Well,
what other indicators do you want to look at as well? Not necessarily.
I like looking at big stocks that make up a lot of these indexes. What I've kind of noticed, it seems like a lot of biotechs are starting to get money poured into biotechs. I feel like the NASDAQ is an index that could move higher, therefore just the overall market move higher. I think crude oil testing, which I do think it will test 50 this week, the correlation between crude oil and the S&P. Obviously with crude oil moving up, U.S. equities like the S&P index, for example, will move higher. So that's what's really I'm looking at. So I guess this week would be crude oil stabilizing around 50 or exceeding 50, therefore the S&P following crude oil moving up higher as well. I think a lot of these NASDAQ names like Google, Apple could start filling the gap to the upside. Biotechs I like in the NASDAQ. So I think there's individual stocks that will weigh the indexes higher, and I think crude oil is probably the #1 thing that the S&P will head higher.
Okay, interesting. Yeah, I've noticed the NASDAQ too. About well, not this past Friday, but the Friday before, I have a little indicator I use that measures relative strength of the NASDAQ versus the S&P 500, and it looks back over about a 10-week period. And generally, when the NASDAQ has been leading, that's when the market's made its headway.
Right. It makes all the sense in the world. That's
Yeah.
the one sector everyone wants to own.
Yeah.
And it's the cheapest sector in the market. I keep telling my people, you want to own stocks, they're just going to keep coming back to the same sectors over and over again. That's tech, biotech, cybersecurity, the safe plays.
Yep. Right. All right, Dean, I teased you earlier and said I was going to listen to you a little bit. Well, why don't we go to you now?
Okay, I can take it. I can take it. All right, I should be showing a chart here, the E-mini on a 60-minute chart. Is that showing up?
Yep. Yeah, it looks good.
Okay. Yeah, it's funny. Lance, your comment about oil. It's been strange about the correlation between oil and the indexes. Right? There's a short-term positive correlation, but that's not a historic relationship. Historically, they are inversely correlated. I keep waiting for people to wake up and go, "Oh, wait, higher cost oil means higher cost for most of the market. A very small part of the market benefits from higher cost oil." But right now, it is moving with oil. and we've been long on oil for quite a while, and we think natural gas is lagging. It's going to break out pretty soon as well. But on the E-mini S&P 500, the basis for my thinking we're going lower this week is just a real simple Elliott wave analysis, and we got a wave 1, 2, and then this big move up in late May, pretty clear 3, and now it's consolidating. And if I just look at a quick retracement, a Fibonacci retracement off that, we're looking for it to go down 2083 to 2067, but it hasn't proven it. We use Dow theory to prove when a new trend has started. We're looking for lower low, lower high, and then a new low to really prove when it's heading down. Now on the it's funny, on the S&P 500 itself, 2111 is the latest high from either this May or April. The latest high it made before it pulled back a little bit. And we're really close to that. If the S&P takes out 2111, then it probably is going to go on and make new highs. But I joke about that in my newsletter. I got a free newsletter that I send out every week, and I said, if this still is a bull market, we probably could call it a steer market, right? 'Cause it's not going to have any bigger, right? If you know the difference between a bull and a steer, right? We may go make new highs, but I think they're going to be pretty anemic. And at some point, when you look at the S&P on a weekly chart, we've been in a 5 or 6 year bull market that is absolutely losing steam, and it's going to correct at some time, and it's going to be really fun and really dramatic and really exciting, and there's going to be a lot of profit to be made. And I can't wait, because I think whatever upside there's left is pretty weak, and it's nearly sideways, and it'll crawl its way up maybe to new highs. But the real fun's going to start when the correction begins, and we're looking forward to that and waiting until, John used a term earlier that I think said, the market will tell us, and it will. I love technical analysis, and the market absolutely talks to us and proves what it's going to do, and gives you a high probability to trade on. So, but that's my story. I'm sticking to it. I could be wrong, but I'm not.
Yeah, if I could jump in here for a second, that chart that you just had up there tells you don't want to be trading stocks. They're not moving. All of the winning trades we've had this year have been in currencies, gold and oil. We bought the January lows in gold and oil, and we've been selling every spike in the yen on the short side. And that's working. The trade, the equity trades, you're really grinding out a few points or stopping out either way for a flat return. It's just not worth the effort. This market is telling you, stay away. You give me your money, and I'm going to screw you.
But it depends on the sector too. So we've traded when gold proved that it was heading up into its recovery earlier this year. We traded gold-related equities, and we hit it out of the park. And we traded oil-related equities and hit those out of the park. So it depends on the sector, right? So I don't say all equities are sitting flat. They're not. But the index-based ones that are related to the index, I totally agree with your statement.
Yeah, and that's absolutely true. Within the sector, there have been absolutely massive sector rotation. Into gold stocks, out of gold stocks, into energy, in and out of tech, in and out of biotech. So yeah, if you're fast enough to catch those, this actually is quite a good market.
Well, it sounds like you caught a few of them, Dean, so that's good. All right, let's move on to Henry. Henry, you want to let us know a little bit about the indicators you're looking at, or that you like to look at, and why, and maybe what they're telling you right now.
Sure. So, we obviously keep a close eye on the put call. We kind of segment it even further to out-of-the-money calls and out-of-the-money puts, and trying to examine specifically the buying activity. It is very interesting, and what these guys were saying in terms of, do you want to be in stocks? There's kind of a bifurcation going on where the ETFs are having these pockets of incredible option activity. XLF a few weeks ago, which is the financial ETF, insane call buying. 200, 300,000 contracts bought to open. We're talking about like $20, $30 million positions that have a lifespan of 3 weeks. Some of them have kind of nailed it. Especially those financials a few weeks ago. In the single stock world, it's different. There is a lot of kind of stock picking going on. Once we got through kind of the tail end of earnings, we're seeing all sorts of little pockets of activity, and you know, you guys are right. The rotation that's happening is very noticeable. I mean, energy, you know, I think continues to pull in some new money as people just kind of, you know, the stability seems to be there. So people are like, all right, well, you know, oil's not going to crash down to $20, and it feels like these companies that were just on the brink, you know, that have now all rallied 30-40%, are going to be around. You know, and whether or not they're going to have the kind of yield they used to have is a different story. But it kind of looks like you know, there's new money going into those. You know, we haven't seen any panic. You know, even you know, last week. You know, it's very, very brief, and then, you know, it's people jump right back in. Let's get long again. So, you know, we're just continuing to watch it, you know, and look for kind of signs of people really stepping away. You know, and I do agree there's a decent chance we get a scary little downdraft. You know, maybe as people, you know, if the confluence of politics and Brexit and you know, something negative out of Asia spooks people, you could see a move that, you know, would be quick and you know, really dramatic. But in the meantime, it's kind of, you know, business as usual, which is, you know, 0.5% a day, you know, kind of grinding up, and then, you know, some of these days where you may get a 1% range, and then you kind of finish flat. So you know, it does feel a little bit like people are, you know, on vacation or, you know, really not doing that much.
Well, John will be on vacation soon and not doing much.
It's a working vacation.
Yeah, right.
It's a tax-deductible vacation.
All right. I already talked a little bit about what I was looking at, but you guys are talking a little bit longer term here as well. So I figured I'd throw my hat in there. I'm with John that a lot of this is all about the Fed. You know, don't fight the Fed in the long term. And they've been on the market side for quite a while. Although when they stopped with the QE, that's when the real, you know, bull phase ended. They've continued reinvesting maturities, so their system open market account, which is where they hold all of the securities that they bought, has remained around the same size since QE ended. And what I would look out for is if they start selling out of those securities and reducing the size of that account, taking liquidity away from the market. And that's just one other way that they could kind of go against the market in addition to raising rates, right? So that would be another piece of bad news for us. The other thing I'd look for is we are coming up, you know, the presidential cycle, the election. Generally, the fourth year, or the year where there is an election, tends to be a pretty good year for the market. It's the first year that tends to be bad, and part of the reason that may be is that when a new person gets elected, they want to institute their own policies, and one easy way to do that is to tell everybody how rotten the policies were before and say everything's bad and you got to fix it with my stuff. So it kind of creates a negativity, and that negativity can sometimes work its way into the market. And so we will enter next year what would be a difficult year in the 4-year presidential cycle if you look at stock market cycles. So if we get the Fed against us, if we raising rates and we get a new president, and we are going to get a new president, that could issue in a time where we could start seeing some bigger drops. Between now and then, I think we got a good shot to rally. But I don't have a real bullish bias over the very long term. Anyway, those are just a few things I'm looking at. The next question is one I'm also real interested in, knowing that, you know, we got a lot of fairly short-term traders here, and it looked at have you ever or do you currently use auto trading execution with your strategies, or do you manually execute your trades? And how has I guess give a why or why not here too. If it's something that you don't believe in, or that you don't, or you just haven't instituted at this point, but you'd like to do it, or whatever your thoughts are on auto trading. I think it's an interesting topic. I see more and more of this robo-advising stuff, and I think the market may be going a little bit more that way in the future. So get some experts here, and we can talk about it. I'll really start with Dean this time.
Okay, and I'll really give my answer then. So to interpret the question, is it auto trading in terms of placing trades on behalf of people based on criteria? Is this a true quantitative system that generates signals and takes orders for you? Either way, I can give my answer, right? And so I absolutely auto trade. When I see a good setup that meets all of my rules, I automatically go manually place an order and take the trade. But I do not let the computer take charge and place trades for me. I wanted that to work so badly, right? I'd spent hundreds of hours programming in easy language and TradeStation, trying to come up with an automated strategy to day trade for me, and I was not able to make that successful. I could take pretty much any trading period and go create a system that would look back and trade it very profitably. I could never make it work going forward.
Yeah,
so
right.
I abandoned that effort at some point and said, all that effort I spent trying to get the black box to work, I could have been spent analyzing markets and placing trades according to rules that I do know work. So I know there's people that do it, that sell those systems, and with apparent success. I have not been able to do it with success, and I'm focused on a way that I have been able to make good money at. And I've had subscribers ask me about auto trade, where for my stock pick service, could we set it up and I would kick out orders for them, and that makes me nervous too. So no, not planning to offer that service. I'll do the advisory. My whole thing is, here's what I'm doing, but I'm not a financial advisor. I'm not giving you advice. You're welcome to follow what I'm doing or to modify that, but you take the risk on. You make the decision yourself.
Okay, so you're follow me trades, not auto follow me trades.
That's right. That's right.
All right.
Absolutely. Yeah, I think that's a whole different level of risk, and then you have a fiduciary responsibility. And I publish my track record. There's full transparency, all that. But I think it's important for people to manage their own money and make their own decisions. So that's just a philosophical position too, as well as a I don't want to get sued position.
Yeah.
Okay. Henry, why don't we go to you? I've been making you go last each time.
Sure. I kind of agree that I mean, you got to be a little skeptical and say, look, if it was going to make that much money, are they really going to let people pay $99 a month to jump in? What we see, I actually think that on the options side, there's all sorts of kind of exciting things developing in terms of trade selection and back testing and being much more methodical about the one part of the whole trading process that has been kind of typically done seat of the pants is getting scientific and getting quantitative, which is really pretty great to see. Now, and that kind of does play right into the whole betterment and wealth front concept, which I guess is automated trading kind of for the masses. So I do think kind of things are tiptoeing into it. That's very different than the auto trade systems that a handful of brokers still permit. I know a bunch of brokers basically turn them off because of the it was always slightly in the gray area anyway in terms of compliance and suitability and everything else. But you see things. I was just listening to a great Tim Ferriss podcast on kind of what the next hot things are, and he's all about artificial intelligence, and you have these sites like Quantopian, which I've played around with a little bit, but basically you can go and build algorithms. Now the downside there is I think that the company gets to sniff through what you're doing and try to figure out if there's anything meaty to it. They say they'll back you if it's good enough, but I'm sure at that point you've given it away. But to see, and then Google's also got this, TensorFlow artificial intelligence engine that they're open sourcing. So, that just leads right into some really exciting things that kind of typically have been done by behind curtains and that kind of thing. So I think there's all sorts of ways to make money. The guys that I know that make good money consistently do have a very, very rigorous strategy. And if it's that rigorous, it basically is an algorithm, right? They're just implementing it kind of manually. So if I have a friend who says, yeah, we sell 1.5 standard deviation puts with a certain expiration, and we roll them when this happens, code the whole thing up and then move on to the next idea. And I think that's really how the old guys like us might still, or like me, might still be swinging around big old blocks and punting. The younger guys are coming into this with a really different perspective and saying, okay, yeah, you know what? I'm going to trade anything that's tradable, and I'm going to trade it very scientifically, and I'm not going to put my fingers into it and say, oh, no, I don't want to buy calls on Activision. I want to buy calls on Microsoft. That's not how. That's the old style, and the new style is very quantitative, and it can be challenging if you're kind of a little trader trying to still pick your spots. You have to kind of be one step ahead of it and say, okay, we have a big old shakeup now. Where does that put PEs in energy? And now let's look through this whole landscape and say, okay, well, here's a couple that are really beaten down. Here's a couple that have held up really well, and is that a trade? Because in a way, you're kind of trying to play the same game and not just pick a stock because you like the product or even the fundamentals.
All right, good feedback there. Thank you. Nice perspective, Henry. I'm gonna move on, and I think I got to get going a little quicker here, so we have time to give closing comments at the end. So let's go to John, and then Lance. I'll save the best for last for you. So.
Well, my closing comment will be that I don't believe in auto trading at all for 2 seconds. There are just so many reasons why this can't work. You almost can't count them. Somebody mentioned it was a gray area legally, except with the SEC. They think it's illegal. And there are no gray areas at the SEC. They think it's illegal, and they have started to shut down various auto trading programs. So we won't touch this with a 10-foot pole. People have been trying to get me to do this for 10 years, and I won't do it. Second, we are in a period of secular declining liquidity in the markets as numerous players withdraw from market making and so on. So, whereas auto trading would be dependent on rising volumes. There's no way those two fit together and work. There have been a number of auto trading blow-ups where there was a total loss of capital involved. So, I think that stock markets, with the exceptions of high-frequency traders who are essentially going after pennies, people like Renaissance, stock markets may well be the last redoubt of the human participation in the modern economy. All that said, have a nice vacation.
All right. All right, Lance, what do you got to say about it?
I'm not a believer in the automated trading. I'd rather click the mouse and do it myself. I develop strategies, like for example on the S&P mini futures, I created an indicator for Thinkorswim called the tick indicator. Simple, positive ticks, negative ticks, positive 800 as aggressive buying, negative 800 aggressive selling. I'd rather use something that I created, know the math, know the formula behind it, and follow it for trading, say indicator. But as far as automating all my trading, I just don't believe it. There's too much that could go wrong compared to how it will be profitable. It's just not worth the risk, I feel like, for my personal trading.
Okay. I'm going to take the opposite side of almost everybody here. I like it. I never used to do it. Most of my strategies were swing term and and overnight, and I've always, while some of my swing trading is discretionary. Well, I wouldn't call it discretionary, but I'll look at the evidence in front of me. So I'll look at a bunch of studies, and I'll determine whether I want to take the trade or not based on the data. But I do have some systems that, if something triggers, I take it. And I've always taken that manually, especially from a swing trading point of view. Now at InvestiQuant, we also offer day trading type strategies, and I've never, for the last many years, I haven't done a whole lot of day trading because I generally enjoy doing my research during the day, and I don't often follow the market on a tick-by-tick basis. So I haven't been able to take advantage of some of the day trading or intraday trading type of strategies that I might be able to if I was following the market. And myself, and frankly, I like it from the fact that I can diversify a little bit. I don't have to put a whole lot of eggs in one basket, but a few contracts here, a few contracts there. I don't have to think about it. It does what it's supposed to do. I do check on the trades to make sure they go off, but I don't have to really worry about it. So for me, it's kind of it's a nice thing to have. I think it's you build your strategies and you take the human involvement out of it a lot of the time, and you're better off for a lot of people. So rather than just manually clicking the button, I can have a bunch of trades going at once, and I don't have to be clicking all these buttons once I set them up for auto trading. So maybe a year ago I would have been with you guys. Now that I've started doing it, I like it. So that's where I'm at with that. Why don't I go around? We got to wrap it up here, so we got just a minute each maybe, and tell us and anything else you want to tell us about yourself. If you have any promos going on right now, that's fine. Why don't we start with Lance? I'll go down from top to bottom here again. Lance is at Alpha Shark. If you want to tell us anything going on at Alpha Shark, and I do suggest people, if you're going to check out Alpha Shark, check it out soon because it might blow away in a tropical storm in the next day or so.
Yeah, so at Alpha Shark, we do have a live trading room from 8:30 a.m. Eastern Time till 4:30 p.m. Eastern Time. We're a platinum member. Can become a member, see how myself, Andrew, Tara, Raul, Jeff, and James trade throughout the day. We also have about 200 members online right now on the live chat where everyone posts their trade ideas, what they're thinking of the overall market. So I do encourage everyone to check it out. And you can follow me, Lance Ippolito, my Twitter handle, or email me, lance@alphashark.com.
Excellent. I hope people take advantage of that. John, the Mad Hedge Fund Trader.
Yes, you can go to our website at www.madhedgefundtrader.com or just Google Mad Hedge Fund Trader and sign up at our website. We'll get you some free research, some free trade alerts. We're one of the oldest letters out there. I've been in the market myself for 50 years. I was trading when Abraham Lincoln was president. I've been doing this for so long. But I love doing it. I love making money for people. So we cover stocks, bonds, commodities, currencies, precious metals, and real estate. And our stock trading is all focused on the 5 or 10 sectors which are going to dominate the economy for the next 20 years. And it doesn't hurt that I spend most of my time in Silicon Valley. And I think artificial intelligence is much better saved for your car, you're driving your car around, than your stock portfolio. I was driving a self-driving Tesla over the weekend, which can drive better than I can. You know? So buy the car, but not the stock. Stock's impossible to trade. So I look forward to working with you all in the future.
Thanks, John. It was nice getting to meet you and talk to you. Enjoy Switzerland.
Oh, I will.
All right, Dean, back to you.
Okay.
Give us a little bit. Give us a little wrap up with, and tell us people how they can learn more about Follow Me Trades.
Yeah. So hopefully you're seeing my homepage now. I hope that's sharing correctly. So again, Follow Me Trades. That's the website, followmetrades.com, and we just kicked off a live trading room a couple months ago, and it's going really well. We're getting good returns, good turnout, and people can check it out and find out more here on our website by clicking on it. And it's $27 a month discount right now, so a pretty good deal to come trade with us for 2 hours a day, live futures markets, gold, ES, and oil. And we also review any stock picks folks are interested, share some of our ideas, and do a little bit of teaching and training. And it's been good. So folks can go to my website, followmetrades.com, and check it out. And more information, there's a contact us form. There's a free newsletter here as well, just to find out what we're thinking about the market. So that comes out every week. So I encourage folks to check it out, and we'd love to see them there. And it's cool talking with everybody, and that's really interesting that you have moved over to auto trading. That's intriguing. I want a black box that'll just print money. I want it. So, anyway, thanks. It was great to be on the show. I always enjoy this. This is good fun. So.
All right, thanks. Thanks, Dean. I hope we get to talk again on the show sometime in the future. It's always interesting talking to you. And then last but not least, well, I guess I'm last. And I'm still not least, but neither Henry nor I are least. Henry, let's go to you.
I think every time you come to me, it's like last but not least, but for other people, it's saving the best for last. So I'm a little bit annoyed. I want to know if John's going to Switzerland to make a deposit or what.
I tell you, Swiss bank secrecy is a total myth. The second you try to open an account there, they notify the IRS. And that's been true for 20 years.
Interesting. Yeah, I was reading something about that. I think now you got to go. Actually, there was something recent that said the best place to hide assets is U.S. real estate. So.
Yeah, no, the best place to hide assets is Nevada, Wyoming, and Delaware.
There you go. Okay.
Huh.
Rob, I mentioned I didn't mean to bash auto trading. I like disciplined and I guess algorithmic trading. Because I think all of us know that the biggest mistakes people make are the inconsistency. And on the money machine idea, there is a client of ours who's had a trading firm for a long time, and his company name was My ATM. So. And he did fine for a long time. So we are continuing to enhance our offering. Whatstrading.com is the place to go to see what we have. Some interesting charts, all the content that we put out for the institutional side. As I mentioned, basically we enhance it and kind of simplify it, to kind of take away some of the noise so that we don't baffle self-directed retail traders. We do have a coupon code, which is option flow, which will get you the first month for $29 instead of $149. So it's a bargain, and then if you hate it, you can cancel it. And keep an eye on us. We're Option Alert on Twitter. We're kind of out there in the sphere. We put a lot of stuff out on LinkedIn. So we hope to hear from people.
All right, great. Well, I hope people check you out. TradeAlert and webstrading.com there. I'm sorry, whatstrading.com.
Yes.
Whatstrading.com. Nice talking to you as well, Henry, and everybody else. Like I said, you can find me at quantifiableedge.com or investaquant.com. Investaquant, I will be doing a little webinar next week. You can keep an eye out for that. I think it's next Tuesday or Wednesday that'll talk in detail about our swing trading service. Which is not auto trading right now, but if you do have some interest in auto trading, we do have some auto trading applications, and we'll probably have some more over time. So that's if that is something you're interested in, you can check that out. Check out the swing stuff. No matter what, it's all quantitative based, and like I said, it looks at combinations of price action and seasonality. Quantifiable edge is all quantitative based as well. David, always fun being here. Always nice when we don't always agree on everything. I think the first time I came on, everybody had the same opinion, and it was boring as hell. So.
Yeah, that's the one problem. There's a little too much agreement, but
and then the market does the exact opposite.
Yeah.
And what everyone agrees on.
Yeah. But yeah, lots of good discussion this week and good information. So thank you all, and just want to remind everyone watching, you can go to TimingResearch.com and view any of the past reports or any of the past shows. The archive for this one will be up there in a few minutes as well. Next Monday, if you join us next Monday, we'll have Cameron Yost, Christian Fromhertz, Larry Gaines, Ed Carlson, and Dave Landry as host. So I just want to thank my guests again for this week. Lance Ippolito of AlphaShark.com, John Thomas of MadHedgeFundTrader.com, Dean Jenkins of FollowMeTrade.com, Henry Schwartz of TradeAlert.com, and of course Rob Hanna of InvestaQuant.com. Thank you for hosting again, and thanks, guys.
Good luck and good trading.
Okay.